CF Benchmarks.
We've been publishing an annual advisor survey that gauges financial advisor and institutional advisor attitudes toward crypto. This is our 8th survey, and the results this year were phenomenal. We are seeing incredible momentum in the crypto space in terms of institutional adoption. Some of the insights from this year's report are that more professional advisors own crypto personally than ever before, and a higher proportion of them are allocating to crypto than ever before. So we found in the survey that 32% of advisors are allocating to crypto in client accounts. That's up from 22% in last year's survey, and it's the highest of all the surveys we've taken. Another really interesting thing we found is that the allocation size within portfolios is growing. So, a couple of years back at the start of when the Bitcoin ETFs launched, we were seeing advisors generally allocate around 1% of the portfolio. This year, we saw that 64% of the allocations in portfolios were 2% or greater in size, and that is up from 51% last year. So allocation size is growing, which shows more conviction from advisors, and that's incredible to see. And then we're also seeing that access by institutional investors is rising as well. 42% of advisors told us that they're now able to buy crypto in client accounts, and that's up from 35% last year and up from the year before as well. So we continue to see access increase to the asset class by the professional advisor community, which is great to see.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance. Brought to you by CF Benchmarks, the world's largest crypto index provider. Hey everybody, thanks for joining us for another episode of CFB Talks Digital Assets. My name is Ken O'Deleger, I'm head of content, and as usual, I'm joined by my colleagues, Gabe Selby, who's head of research, and Mark Polipchuk, who's our research analyst. And today we are absolutely delighted because we have another guest from one of our favorite, obviously, clients. This time it is Juan Leon, who is senior strategist at Bitwise. And the first time we've had Juan on the show. So Juan, thank you very much for taking time out to join us.
Oh, happy to be here. Thanks for having me, Ken, Mark, and Gabe.
Brilliant. And as I alluded to, guys, it is still pretty much the beginning of a new year. And this follows a remarkably tumultuous 2025, and that was just in crypto, of course. So it's that season when we look ahead to the upcoming year that we're facing, basically what we call outlook season in investment management. Both CF Benchmarks and, of course, Bitwise have published several forward-looking pieces of research, lots of them, some great insights in both. We will dig into those, but of course, the marketplace keeps going. We will also talk about what's happening in the market and any new initiatives that Bitwise has got planned for the year or has got going on right now. So to get things going on this theme, the CF Benchmarks 2026 outlook, or at least the outlook for the first quarter of the year, is subtitled Risk on Reloaded, which implies a more supportive backdrop for risk, of course, for 2026. Judging by their best estimates, of our research team, Gabe and Mark. But obviously, that is not likely to happen in a straight line. So to flesh things out, maybe I'll jump to Gabe first, and you can give us a synopsis, and then maybe jump into a question for our guest as well.
Yeah, so with 2026, it's going to be, I think, a story of a little bit of noise up front. I mean, we just came out of the longest government shutdown in U.S. history, and we've seen how that's kind of impacted some of the key statistics that we're following closely to help determine things like our monetary policy path and so forth. So what we would categorize that as, we're seeing disinflation with some noise. Overall, we think, if we look at things like job growth, we look at things like inflation, we look at things like GDP growth. Let's just break down each one. So inflation, obviously, we saw how the November print had a lot of missing categories. And the sampling window is also kind of really advantageous for just sampling around the holiday of Thanksgiving and Black Friday discounts. With GDP growth, we're still seeing a lot of, net import and export dynamics impact that. So a lot of trade related, a lot of inventory swings. And with the labor market, again, we've just seen kind of like how the government has shut down has kind of impacted sampling. When we look towards 2026, we expect that to slowly kind of smooth out. But importantly, we call this risk on reloaded because we think the macro backdrop is going to primarily, turn more favorable because of the monetary impulse that we're going to see through the Federal Reserve vis-a-vis a pathway that allows them to kind of embark on more rate cuts than particularly what the market's expecting. So right now, the market's only expecting, I think, between a little over 2 rate cuts. Let's just round it down to 2. And we see, over 100 basis points of reduction, primarily driven by the politicization of the Fed, the pressure that we're seeing for the Fed to cut rates, but also just the macro side. We think the labor market weakness is going to kind of keep the hawks at bay. And we think that, that one-time tariff push on inflation is over. So we're going to see, productivity kind of help keep a cap on labor costs. And ultimately, the rate of change of inflation becomes less of a problem in 2026. Let's just say this, could be like more of a Goldilocks environment where you get, growth to just kind of mostly stabilize in 2026. You don't maybe see, roaring growth because, again, if you start seeing, 4, 5, 6% prints on GDP, that's going to be, what do you think the Fed's going to do? So we think it's more of a Goldilocks. We see, some gradualization in consumer spending. We see, inflation obviously peaking in the near term and starting to come down. And we see a much more accommodative Fed with really the shift from quantitative tightening to more expansion of the balance sheet. So overall, that's kind of like the macro side of risk on reloaded. And Juan, I would be curious, from the Bitwise team, you guys have put out your predictions, and what are you seeing on the macro side that's giving you some catalyst for either, more appetite for risky assets such as digital assets, across the board?
Yeah, agree on many fronts with what you posed for the macro outlook. On our side, for crypto specific, we think one, even though price action was disappointing last year, it actually created a great reset in expectations, and I think some of the sentiment. And so I think it sets us up really well for this year, especially given the fundamental momentum we saw last year in terms of regulatory adoption, in terms of institutional adoption, that wasn't really reflected in the price. I think that continued momentum into this year is really going to sets us up for a great year. And for one of our predictions for this year, which is maybe our boldest prediction given what's happened in the past within crypto, is that we believe the four-year cycle is dead and gone for good. So Bitcoin, as we know, has historically moved in 4-year cycles with 3 significant up years, followed by a sharp pullback year. Those pullback years in the past happened in 2014, 2018, 2022. And by that dynamic, we should have a down year in 2026. But we don't see that happening. In our view, that's because the forces that previously drove those 4-year cycles, things like the Bitcoin halving, things like interest rate cycles, things like big blowups in the space, those things are less significant today than they have been in the past. If we look at the halving, as the asset class gets bigger and as Bitcoin gets bigger, each subsequent halving is half as important as a prior one. And so at this point, we think the effects are marginal. For interest rates, they rose substantially in 2018 and 2022, hurting prices. But in 2026, as you were just talking about, the expectation is for them to fall and perhaps for more rate cuts than are priced in right now. And then in terms of blowups in the space, we saw the significant deleveraging following October. And so I think that paired along with improving regulation sets us up well for no more of those big time events this year. And then more importantly, we have big tailwinds from institutional capital beginning to enter the space. We saw it towards the end of last year. Big players, Morgan Stanley, Merrill Lynch, Vanguard, approve access to crypto for their clients starting this year. So we think that's a big wave of capital that's coming into the space this year. And at the same time, I think we'll feel more of the benefits of the pro-crypto regulatory shift that began last year. We had the Genius Act pass, which was the first piece of crypto legislation that will start catalyzing momentum in stablecoins at a faster clip this year. And even though there's some hurdles right now with the Clarity Act,
Yeah.
we believe that we'll be able to work our way through those and continue that regulatory momentum this year. So we're very
Yeah.
constructive on 2026. We think it's going to be a strong performance year, and we think that'll render the 4-year cycle gone.
I think it was super timely that you just touched on some of the regulatory stuff that's going on, given what happened with the banking committee and Coinbase pulling support for the bill just a couple days ago. I'd be curious to get kind of Bitwise's prediction or thoughts here on where we might be headed and what the timeline could look like, given we're starting to see things push back a little bit.
Yeah, we saw, well, yesterday, as we saw, negotiations deteriorated and lawmakers were unable to agree on several key points around stablecoin yield, security tokenization, DeFi application oversight. And I think Brian Armstrong is right in calling out the bill proposal because it really contains significant issues. It basically contains a de facto ban on tokenized equities. It has significant DeFi prohibitions, which give the government unlimited access to financial records and remove significant privacy. The proposal erodes the CFTC's authority, which would stifle innovation and make it almost subservient to the SEC. And there were draft amendments in there as well that would effectively shut down stablecoin rewards and allow the banks to
Yeah.
ban their competition. So the expectations now I think are pulled back. There's going to be, I think they're shooting for a new markup next week and possibly debated against at the end of the week. But we're starting to see that friction come up. But while that is disappointing, I think it's best that we get this right. So I think the pushback is warranted. I think everyone is really focused on it now. I think there's a lot of momentum within lawmakers to push this forward. And so I'm optimistic that there will be compromises that end up balancing the innovation with consumer protections, and that will allow the bill to really push this industry forward. There's concern that this pro crypto administration that has pushed so many things forward on the regulatory front that could be reversed in the next administration if they're not pro crypto. And in our view, there's a dichotomy there. Yes, some of the things from the SEC, the CFTC, those things that can change from administration to an administration could be changing. But what's important is what's codified into law. So the Genius Act, which was passed into law, that is much harder to be reined back once it's a legislature package. And so we think it's really important for the Clarity Act to also be enshrined into law, because the Genius Act now provides a regulatory framework in a legal framework for stablecoins, but we need the Clarity Act, which will provide the broader market structure. And so we're optimistic about it.
So Juan, just if I can get you to hazard a guess in terms of those compromises, what would they look like for the key ones? The stable coin yield, implied prohibition, the DeFi participation. Those three top ones which Mr. Armstrong called out.
Mm-hmm.
What is your basic way of compromising that would actually is likely to go through? Because that is obviously what needs to happen. But what does it look like?
Yeah, it's a good question. We'll definitely have to see what shakes out. But I imagine maybe on stablecoin yield via rewards or whatever mechanism they call it, that is being pushed back on by the banks. If they were going to come to a compromise, I think it might look like some kind of cap on how much yield they can offer to maybe make it more parity with money market funds, or hopefully it doesn't end up in something that favors banks as issuers specifically vis-a-vis non-bank entities. That might be something the banks push for. We'll see. Hopefully it doesn't end up in that. On the DeFi prohibitions, I think it's just they need to flesh out how to balance privacy with financial disclosure. And I think they'll get there. I think there's mechanisms for DeFi to provide transparency that can comply with consumer protection concerns. And then, on tokenization, there's a big push for tokenization, even from Wall Street. So I think that they'll be able to figure out how to push that forward as well.
And then on the advisor allocation front, for those advisors that are still currently sidelined, how many of them are waiting for the market structure bill before they allocate? Or is this something that they're assuming is going to eventually happen?
Yeah, we pose a question around your biggest concerns preventing you from allocating, and consistently year to year regulation is a big one. This year it was as well, even though we saw regulatory wins last year. I think it's partly reflective of, you know, people want to see the full broad market spectrum bill that regulates the entire industry be passed into law. But I also think there might be something in there that is a bit of another question we posed this past year is it showed that about half of advisors were restricted by their home base to allocate. And that was very close to the percentage that are also still concerned about regulation. And so it may be that that reflects more of the house view, so to speak, of their home office and less the personal view of the advisor, the concern about regulation. But I definitely think either way, the Clarity Act is crucial.
I think Juan's spot on. And, if you think about Clarity Act or market structure bill, it's just a much more complicated piece of legislation than what we got
Oh,
last
yeah.
year with the stablecoin, the Genius Act. It was stablecoin Genius Act was more of like a checklist of, of how do you issue out the licenses? What are the reserve requirements going to be? How is the KYC? What are the protections? What's the transparency going to be? What's the audit process? This is very, very complicated. And so, I'm just going to be keeping a close eye on the banking committee and seeing what they ultimately start proposing, because we know, well, one, it was pretty surprising to see, I think a JP Morgan executive put out a statement, kind
Yeah.
of arguing against stablecoin yields. So that's kind of like if you're at the poker table, that's kind of like they're showing you their hand a little bit. They're kind of nervous a little bit. JP Morgan's the juggernaut. It's the fortress, right? Fortress diamond.
Yeah.
So
When you've got to wear a number of hats, it's always a bit difficult, right? Yeah.
it is, yeah.
Yeah.
And if you have to kind of speculate, the bank lobbies are very powerful, and they're clearly, probably in the ears of those committee members. And so I'm keeping a very close eye on kind of what that committee is saying, because ultimately, I do think the industry needs to get this right. I think it needs to not be just a thing that we pass just to pass. If we want it to actually be a piece of legislation that fosters real innovation and pushes the industry forward. So I'm glad that we didn't see kind of like a capitulation and saying,
Yeah.
what, this is as good as it's going to be. Let's just get it done and move forward. They're, hopefully they can continue working on it.
Yeah, I mean, I get the sense that the upset that we perceive among crypto native participants, and maybe a little bit even some of the traditional newcomers into crypto, slightly maybe underestimates the fact that this is actually how legislation happens. There's no, in the same way that markets don't go up in a straight line, legislation doesn't happen in a straight line very often. There's often, fallouts and rancor and all that sort of stuff. So this is pretty normal. And in fact, ironically, maybe slightly reassuring, in fact,
Yeah, let's hope so.
Yeah. Okay. So our guest Juan did mention earlier in relation to the advisors survey that Bitwise put out a few days ago, in fact, something related to allocations and very, very optimistic indications coming from that survey. So let's put that at the heart of our next theme that we can discuss, allocators. That covers not just the RIAs, but also endowments and other institutions. And the sort of catchword here is social proof. So there's a number of ways we can tackle this, but both CF Benchmarks and Bitwise have put out long-term capital market assumptions frameworks specifically for Bitcoin. Now, maybe Juan, you could actually think about how what you're seeing in developments in allocator attitudes and maybe even movement, how that feeds into your long-term capital market assumptions for Bitcoin. Is that a reactive thing that people are getting up to speed with the likelihood of Bitcoin trajectory, generally speaking, within a margin, or some other sort of like major influence that's in helping bring that tailwind?
Well, we are, things like the debasement trade reflecting a concern about fiscal instability, given the level of debt, how much of the government budget the interest is taking, and the continued monetary expansion which Gabe spoke about earlier, those concerns are driving interest to store value assets like Bitcoin. So part of our capital market assumptions for Bitcoin over the next decade is that Bitcoin will continue to gain prominence and emerge as an institutional asset, which will generate consistent inflows into the space over time because of this rising demand for hard asset exposure as a hedge against inflation and monetary debasement, and paired with the inelastic fixed supply of Bitcoin. So the way we think about that coming together over the next decade is we think institutional investors will allocate broadly between 1 to 5% of their portfolios to crypto. That would imply anywhere from 1 trillion to 5 trillion in asset flows to crypto, given the amount of wealth that institutional investors control. Now, we were talking about earlier how one of the things we saw in our advisor survey this year is that the allocation size within portfolios is growing for those that allocate. Allocators are investing more on behalf of their clients, and the allocations in the portfolios are growing. So that's conducive to what we believe will continue to happen over the next decade. We also think the regulatory environment will continue to propel the asset class forward, as we were speaking about. And with the 4-year cycle, which we believe is dead, no longer being relevant, we think that adds power to the continued momentum of the industry. So for us, we think that Bitcoin will be the best performing institutional asset over the next decade. Our base case assumption is 1.3 million price target by 2035, which implies a 28% compound annual growth over the next decade, which is actually significantly lower than the past decade. So we don't expect it'll continue to grow at the rate it has, but it still will be a very compelling growth. And we think its volatility will continue to come down, which will also make it more palatable to professional investors. But at the same time, we think that its correlations to other assets, other major asset classes, will remain low because the drivers for Bitcoin and crypto are different than drivers for traditional asset classes like stocks and bonds. And so we think it'll continue to be a great diversifier in full portfolio.
We're actually pretty close on the money with Bitwise's 10-year forecast, and that was something that is more coincidental than anything, because we of course did kind of a slightly different approach, but we somehow arrived, just slightly north of 1.4 million
so
in 10
very
years. So
similar.
it's not too far off the mark. But as far as career risk, one thing that's always been a challenge when we talk to institutional investors or people that sit on investment committees, they don't understand how to model Bitcoin. They really don't understand, it's an asset that doesn't have, maybe cash flows, doesn't have too long of a history as far as, it's data to support, price returns, correlations, its volatility, et cetera, et cetera. So we wanted to kind of tackle this on from a very practical standpoint and being very just kind of honest and saying, here's a few different ways, laying it out, that you could come up with expected returns, that for a strategic asset allocation, for expected volatilities, and for correlations across the asset class. And so it was a really fun paper to do. And I think, hopefully it serves its purpose as educating, these types of decision makers and helping them understand, this is how you can size it. But one last thing I would say is, how important it is to kind of just be mindful of the fact that when you do long-term capital market assumptions like we did, it's not really a straight line that gives you, that compounded return of, let's just say, north of 20%, 28, 29% each year. If you look at the average return of the S&P 500, it probably landed somewhere between 6 and 8%, right, over the past 100 years. But what's really interesting is that the frequency and the distribution, it very rarely lands in that 6 to 8%. We saw a phenomenal year, of double-digit returns last year in equity markets, and so it's very likely that Bitcoin will also have these types of larger swings around, a high 20s number, and it's not going to be just this perfect linear compounding. It would be great if it was, but that's just simply not how it works in the real world. So I just wanted to kind of finish with that, and I'll let Mark kind of jump in and talk a little bit more about the assumptions.
Yeah, another thing that we really looked at closely was the correlation assumption. And I really liked from Bitwise's outlook how you guys talked about how that decorrelation with risk assets with equities returning. When we did our capital market assumptions paper, we looked back. The last 5 years were an abnormally high correlation to equities. If you go back to from 2015 to 2020, there was actually about zero correlation. So in the long term, correlations are generally mean reverting. So what we would expect is over the next 3-5 years for that correlation to actually come back down to zero, which on a risk adjusted basis, when you factor that in with diminished volatility, you're going to see this probably as one of the better times to be allocating to Bitcoin.
Yeah, perfect. So I just wanted to add something else here in this section. Are you hearing from endowments as these are major allocators, of course, and what is the sort of maybe mood music that you're getting from them? What is the sort of like feedback you're getting from endowments now as regards, I don't want to say full on allocation, but at least really getting on the road to real allocation? What are you hearing?
Yeah, indeed. Endowments are hugely influential and very important in terms of the capital they control. As the Ivy Leagues control something, their endowments control something like almost $1 trillion in capital. So they're really significant. And we believe at Bitwise that we'll see an increasing number of endowments allocate to crypto this year. Already last year, we saw Brown University as the first Ivy League endowment to allocate to Bitcoin. And then we saw Harvard Management Company allocate to Bitcoin as well, and actually double their allocation during the year to where it's now 1% of their portfolio, which is huge. So we think that that is a model that will be followed. You know, Ivy Leagues in many ways are trendsetters. If you guys
Yeah.
remember Yale University's embrace of hedge funds in the early 2000s in their investment program became a massive tailwind to growth of the hedge fund industry over the next 20 years. So we think if other Ivy Leagues clearly are seeing what Brown is doing, what Harvard is doing, and we think that they will follow as well as they not only see that they're doing it, but as the asset class becomes more prominent, regulation sets in. There's now, great work being done by us, by you guys with the capital markets assumptions, which are really helpful. I'm sure you guys, just as us, get a lot of great feedback on that being really helpful because of what you said, Gabe. Institutional investors have a hard time valuing Bitcoin, but these kinds of research papers really help them wrap their heads around it. So we think there's more Ivy Leagues coming, and that's going to increase institutional adoption, which will be great for the space.
Yeah, I
Yeah.
think it's great that you mentioned the Yale and the Yale model. Right
Yeah.
behind me, I have David Swenson's book. I used
You
to work
do.
at Cambridge Associates,
Oh
so
wow!
I worked in endowments and foundations before this, so I'm pretty familiar with
Yeah.
a lot of this. And another problem that ENFs have actually had for the last few years is to hit some of these return hurdles because hedge fund returns have really been lackluster. They've been increasing their illiquidity budget. So we've
Hmm.
seen larger and larger allocations to venture capital and private equity. And then when you think about what happened in 2022 when liquid markets drew down, it really blew out the NAV plus unfunded in some of these portfolios. It was exceeding 50%.
Mm-hmm.
And when we think about both of our capital market assumptions for Bitcoin, we're talking about relatively high returns, decreasing volatility, and low correlation to other asset classes. This could help alleviate a little bit of the illiquidity. And then when you start to think about broader crypto and implementing that into portfolios with index funds, you might see over time some of this illiquid venture us move to a little bit more of crypto, like it's a little bit of liquid venture. So it's a great time to be allocating.
That's a great point especially because crypto is highly liquid and as opposed to private equity, private credit, hedge funds. So for sure.
Yeah.
One thing that I think is going to be interesting is the strategies that you can build around crypto, like harvesting volatility and generating income. I think a lot of people aren't aware of what's around the corner there because, with Bitcoin, some people think it's just something that's just, sits in your portfolio and gets repriced every day and hopefully it goes up. But I think people are going to be surprised in 2026 about the amount of strategies that are going to be coming out that kind of
Yeah.
try to harvest that volatility and create income streams and
Yeah.
package
Different
it in more of
payoffs
like
and
an
all that, different payoff
institutional. Yeah.
structures like that. Another sort of relevant, but somewhat to many people's minds, tangential development. This is a great way of tying in, many things, many themes that we were all looking into last year. Is prediction markets, obviously, which had just a ridiculously stonking year. I believe, looking at the data, I mean, I checked in towards the end of December, it was going to be a year of record volumes again for both the two key prediction markets operating in the States. So that's Kalshi and Polymarket. And we actually wrote quite a large piece on prediction markets. You can go to CF Benchmarks in News and Insights and scroll down to news. That it should still be relatively high up there. But the key link with Bitwise, of course, is that it's one of your predictions for the year. Now, let me read it to make sure I'm not getting it, to make sure I don't butcher it. But basically, prediction number 5, I believe, Polymarket interest hits a new all-time high, surpasses 2024 election levels. Give us some color behind that, and we'll dig into the sort of implication of that. What's behind your spotlighting of that likelihood, Juan?
Yeah. Well, Polymarket had its breakout moment in 2024 during the election. Their most popular prediction market reached $500 million in open interest during that US election. And we think that now that Polymarket is gaining, and prediction markets are gaining traction, they're becoming embedded. You see them now more frequently on the news media being quoted. I don't know if you guys saw the Golden Globes. They were showing them on the live TV, predicting the odds of the winners in real time. So it's really cool to see how mainstream they're becoming. And so we think there's huge growth ahead of them. For Polymarket specifically, it is this year coming into the US market. So it was previously not operating in the US. Now it will be, which is obviously a huge market. It also just raised a big round. It raised $2 billion that will be put to work in expanding its reach. And as I was mentioning, it's going beyond its initial push into politics, and now it's broadening into sports, into popular culture, into economics, so on and so forth. So, and as we've seen, it's growing because prediction markets are, when the markets are liquid, they do have better signal on outcomes than polls. Turns out, if you align the incentives with where people think things are going, if you align those incentives to economics, then people are incentivized to be more truthful or to really reveal their true intentions and their true beliefs. So I think prediction markets are great for making markets more efficient, for getting insight into potential outcomes. And I think they're going to continue to grow massively.
Yeah, and the other aspect of it, of course, I'd like you guys to chime in with is the information venue thesis, if you want to say, because in fact, especially the financial prediction markets, and that includes crypto, of course, they are actually done correctly, and within the United States, they are federally regulated exchange listed instruments. They are basically options. They are, binary options. So therefore, they become an information source with basically unimpeachable veracity. And they become basically, you can actually use them as real world information about assets. So that's another aspect I think that is being looked into, being looked at with a lot of curiosity and interest by institutions. I mean, what do you guys think about that? Juan, have you got any views on that aspect of it at all?
Yeah, I think that it's going to, it does create efficiency in market pricing. So I think for price discovery in markets, it's really helpful. And I think as long as it's regulated correctly to protect market participants, so that there's not manipulation via the liquidity and the volumes, then I think they're potentially the best thing right now that we've come up with for prediction of market outcomes.
I just want to say thanks, Juan, for bringing that Golden Globe tidbit into the conversation. The next time that my wife wants to watch anything like that, she's a big fan. I now have like the perfect thing to kind of follow along with while we're watching it together, and it can kind of bring us closer, as a
family bonding around prediction markets.
Yeah,
who thought that was possible?
Golden Globes as well. Yeah, and the reason why we raise prediction markets, because we're actually on the theme of growth flywheels, basically additional. They could be ancillary, they could be central catalysts for growth within our asset class. Now, thinking within the same theme, stable coins are another pillar. And I think both Outlook reports zero in on stable coins as another arena for continuing growth. So let's get from both sides. Juan, you first. How do stablecoins provide additional broad scale for adoption, and what does that look like?
Well, stablecoins upgrade dollars, right, onto blockchain rails, and that has the potential to increase the reach of the dollar around the world because blockchains are global platforms. They're not siloed to banks or to national borders. So that enables huge scale. And right now, we're seeing, stablecoins have grown to around 300 billion. And even before, the regulation really kicked in, now we have regulation promoting them in the European Union, now here in the US. And we think that's a huge catalyst to upgrade payment gateways around the world and upgrade that technology. So we think there's huge growth ahead. Scott Bessent, the Treasury Secretary, he's forecasted they could go from 300 billion to over 3 trillion over the next 4 or 5 years. That just shows you the massive opportunity. And it puts the Fed right behind them because they're supportive of the treasury market, right? Every stablecoin issued has to, or a dollar stablecoin issued at least, which is the majority of the stablecoin market share right now, is backed by short-term US treasuries. So the more growth there is in that market, the more support there will be for the treasury market, which is very important in a fractured geopolitical world that we're living in today.
Yeah. Yeah. So you're talking to a lot of people, basically way more people than we can ever speak with. I mean, I'm talking about institutions, advisors, and that sort of thing. They're looking at that opportunity. You guys are promulgating that opportunity to them. From their point of view, and I think there's going to be a little bit of this that's a function of, maybe the level of awareness and knowledge of blockchain, cryptocurrency, the digital asset universe. How do you propose to sort of an advisor that's interested in this theme, this branch, to actually capitalize, to invest in it?
Mm-hmm.
There's not necessarily, what direct way. What would you suggest?
Yeah, there's growing avenues to participate in that opportunity. There's the underlying blockchains on which stablecoins transact. Those are primarily Ethereum and Solana today. So that is catalyzing great interest, investment interest in Ethereum, in Solana. There's also the companies building platforms like Coinbase as well. Circle, which is the issuer of the second largest stablecoin, USDC, went public last year. It had a huge IPO. And that's a direct way investors can play it as well. More recently, for example, I mentioned we put out a Chainlink ETF this week. Chainlink provides the real-time price feeds for stablecoins, for tokenized assets that are allowed these things to function. So that's another infrastructure play that investors are becoming more interested in. So we're seeing more avenues for investors to participate, especially in these regulated ETF formats. And that is really catalyzing adoption and investment participation beyond just retail investors to the institutional crowd.
Yeah, I would say for me, what I would like to see in 2026 from an adoption standpoint is for users of stablecoins to transact in more of like a utilitarian fashion. So using those rails to purchase something that perhaps, maybe you're shopping for a used car, on the weekend and all the banks are closed. And it'd be just really cool to hear stories about, how people are really kind of adopting it in the manner that, the technology best serves it to operate. And the other thing that I think was interesting was, I think in the 10 predictions for 2026 from your team, Juan, was the talk about emerging markets. And you guys predicted that, next year we would see them get blamed for destabilizing EM currencies. And, every day now I see headlines, geopolitical risks flaring up, sanctions being rolled on. Do you want to talk a little bit more about that prediction and
Yeah,
what the thesis is?
that's kind of a juicy, controversial prediction in many ways. But look, we all saw how unexpectedly this year began with the incursion in Venezuela. I mean, who saw that one coming as a New Year's gift? Not a gift at all, but like it really took us all by surprise. And I think that highlights what, exactly the type of situation that we put out in our prediction, which is, stablecoins are growing fast. They are the better, cheaper, and faster way to move money. But central banks are many of them are threatened by that, by it. I mean,
Yeah.
for reserve currencies and high value currencies like the US dollar, it's not a threat because they act as reserve currency, as the currency that everyone wants to get access to. But for countries where their economic systems and their currencies are being consistently devalued at very high rates, then dollar-based stablecoins are a threat. And we're seeing, we've seen historically the adoption of US dollar stablecoins be the highest in countries with political and economic instability, with
Yes.
high inflation rates like Argentina, like Venezuela, like Turkey, like Nigeria. So these are
Nigeria.
the
Yeah.
these are the areas where we foresee a situation where there's economic instability, and the scapegoat for the government becomes
It's like,
stablecoins.
yeah,
Yeah, they're like,
yeah.
this is all because of stablecoins. They're destabilizing our economy, they're destabilizing our currency, and of course, it's just a scapegoat. They are mismanaging their economies, but we can see how central banks in developing countries who are struggling to maintain their currencies may use this as a way to blame their own
Yeah.
incompetence, or to try to excuse their own incompetence.
It's an excellent insight to put on the map. It provides that little bit of caution, but also puts in mind for anyone who's interested in that space or that particular area of the space to start thinking about ways to, think past that potential accusation. Let's move on to the final main chunk of our discussion that we've planned. It's tokenization. This is a theme that was already emerging very strongly in 2025. Even CF Benchmarks, we basically were involved with our first tokenized asset, a DTF, a decentralized tokenized folio of one of our capitalization indices, the CF Large Cap Index, which was tokenized by the leading DTF provider in the space. Now, I think that this doesn't necessarily just relate to crypto tokenization. It obviously can relate to real world tokenization as well. And basically, how are you viewing that particular aspect of the space at the moment, Juan? Where are we, and what are the key opportunities investors should be looking at?
Hmm. That's a great question. It's a large area of growth that is
Yeah.
still very nascent. It's a huge market that is very nascent. The total value of real world assets at the start of 2025 was around 5 billion in tokenized assets. Currently, we're sitting at around 20 billion, so it 4x'd in 1 year. But that's 20 billion of a multi-hundred trillion opportunity. If you
Yes.
think about stocks alone, the value of world stocks is 120 trillion. So think about, tokenizing that, and in just that segment, and we're standing at a value of tokenized assets of 20 billion. Huge growth ahead. And then you add on bonds, and then you add on commodities, and then you add on real estate. So the tokenization opportunity for financial assets is enormous. And we now have the technology to make it happen. The first inroads in this were with tokenized money market funds. BlackRock's BUIDL has had huge success. I think it stands around 2.5, 3 billion today. And of course, there's practical reasons why. If you want to settle a trade over the weekend, good luck talking to your bank or prime broker, but you're able to do it with BUIDL because it trades over tokenized rails 24/7. And because of the efficiencies, the technological efficiencies of blockchains, it reduces the cost of settlement. And so it improves capital efficiency. So there's practical reasons why this technology is catching on. And now we just need, again, going back to clarity, the regulatory framework in order to make this
Mm.
happen. But I think there's huge growth ahead, and it's very exciting. It's very cool that you guys tokenize something already. Kudos to you guys. That's very cool.
Thanks. Thanks.
Yeah, something we've kind of been tracking on the tokenization front too is the number of times it's been mentioned in public filings by various companies.
Mm.
Obviously, financial services had the most with over 500 mentions in Q4 earnings calls and other filings they made. But what was interesting is it's not just financials. It's companies like Google, Nvidia, Apple. They're all talking about it. So even these tech companies are going to eventually come in and potentially interact with all these tokenized assets too. And finance is really going to go all over to all different sectors of the market.
Absolutely. We already saw some last year. Some companies start tokenizing their stock, their equity in stock in actual blockchain format. I think there's something like 800 million in tokenized stocks right now. And again, the opportunity worldwide for that is 120 trillion.
That's a really good point, Juan, because if you think about the access issue, the liquidity issue of some of these like private issues,
Yeah.
private stocks that are now being tokenized, it could be a real solution for that. I mean, you could really, not to sound cheesy, but it would help democratize
Yeah.
investing in a sense that people could,
Mhm.
who don't have, institutional grade access to the hottest private company that's, the next unicorn, what have you. They could find that, on a blockchain and at least get some exposure to whatever is, coming through the pipeline that everybody's keeping an eye on, right?
Absolutely.
Yeah.
That's a great point.
And just on that, guys, particularly Juan, Bitwise prediction number 7 in that publication we mentioned is in fact that on-chain vaults, if you like, ETFs too. I mean, I think the DTF framework could actually fit into that category. The prediction that you've got is that they will double AUM within 2026. And the key question here is: do on-chain vaults then, or maybe as we see that happening, become a credible alternative to, a credible alternative to ETFs and other traditional, ways of wrapping investments? In your mind, as a senior investment strategist, what do you say to that?
Yeah, vaults are a small segment of the market that not many people are aware of yet, but they're basically like on-chain investment funds. So users can deposit assets, whether it's in crypto assets or stable assets like stablecoins, in a vault, and that vault will have a mandate, generally curated by some investment manager, to allocate to the funds to different strategies to generate yield within the DeFi ecosystem. So
Yeah.
they started to emerge. I think vaults hit a peak of something like 10 billion in AUM back in October before the deleveraging event, and have been since retracted. But we view this as a new tool in the ongoing evolution of DeFi to becoming more institutionally driven. And we think because it really provides basically an avenue for allocators to have a way to invest in the investment strategies in the DeFi space. We think that there'll be institutional grade risk management that will come into the management of the vaults. And we think that'll attract more capital from capital allocators from the TradFi space. So we think there's great potential in growth in vaults. And we think that they're going to become more prominent in 2026.
That's brilliant. That's brilliant. So, Juan, we as we wrap up, let's deal with what's right in front of us. It's likely to be another exciting year in crypto. We here certainly are of that mind, regardless of market conditions, maybe geopolitical conditions. I'm really excited to hear what is the outline for Bitwise's near term, medium term goals for 2026. And we talked earlier about the new ETF. I believe it's the latest crypto ETF Bitwise has launched, CLNK, Clink, if you like, the Chainlink ETF, which of course references our CMECF Chainlink reference rate, the New York variant. What else have you got in the pipeline as regards ETFs, and maybe any other initiatives that you're looking at for the first few months of the year?
Yeah, thank you for touching on that. We're very excited. We recently launched at the end of last year our first Solana staking ETF, which has become the leading Solana ETF in the U.S. market. That's gathered great assets and great market reception. We just launched the Chainlink ETF that you mentioned, C-Link, and that is also investors. We're seeing investors are very opening their eyes to the opportunity for Chainlink as the commanding infrastructure Oracle play. So there's great excitement there as well. We also think, especially based on the survey results of the preference towards index funds, we uplisted our flagship fund, BitW, the Bitwise 10 fund, into an ETF format. So we're expecting growth for that fund as well. And we're coming up with new solutions. We have various things in the pipeline related to stablecoins and tokenization, provide more exposure to investors there. We have other products that will be coming out in short order related to the debasement trade and how you can play that via crypto and other store value hard assets. And we're consistently looking at innovation. And with the SEC last year simplifying the listing standards, it really opens up the field for new products. And we think us, as well as many others, will launch many other products in 2025 that provide differentiated exposures to investors to participate in the opportunities of crypto. So
Yeah.
we're very excited for the year ahead.
Juan Leon, Senior Investment Strategist of Bitwise, we are very, very appreciative of you coming on board to talk us through how you guys are seeing the beginning of the year and maybe another successful one.
Yeah, thank you very much for having me. This was a great discussion. Really enjoyed being here with you guys, and look forward to what 2026 will bring.
Likewise, likewise. Thanks a lot. Thanks a lot. So that was Juan Leon, Senior Investment Strategist at Bitwise. And I'm sure you guys will agree that was a great way to start the year in terms of CF Benchmark's podcasts. For all other types of insights, cfbenchmarks.com is where you need to go. Other podcasts, we have over 50 of these up there now. Wherever you get your podcasts, you can find them. After you've done that, we'll see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice. This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.